Yo, I'm Brendan. If you've seen the news lately, you know that major changes are happening both nationally and internationally, and that's going to create changes that are ripple effects all throughout our investments. And as a result of that, our financial futures are less certain than ever. Do you want to change that? Today, I'm going to share with you why you shouldn't be looking for a magical single stock, because that's actually going to bankrupt you. The better strategy that I'm going to share is actually going to make you a millionaire. Who am I? Why am I making these claims? Hey, I'm Brendan, and my wife and I became millionaires last year at 37 years old, and I make videos every week, almost every day, so I can share what we've learned and help you do the same exact thing. Don't have something to sell you today. I just want to share with you this better strategy. First of all, why single stocks don't work. This is an important distinction we need to make, because I think a lot of people imagine investing as, I've got to find the right stock, I've got to go all in it, I've got to gamble my money and then win big, right? We want to go from $1,000 to $1 million. We want some kind of amazing make it rain payday. But the truth is that there's no one stock that's going to provide the kind of wealth building power that we all want and really need. If you've been looking for a stock like that for a while and you've watched a video or read an article or something where someone claims, hey, this stock is about to pop, you've got to buy it right now before it happens, quick, you got to act, this thing's going to explode, we're all going to get rich. Well, then it's a very valuable bit of information you gathered, because that person that made that piece of content has shown themselves to not be trustworthy. Let's think about that logically for a second. If they knew for certain what they were claiming was true, they would borrow as much money as they could, max out credit cards, they take out a HELOC on their house, they'd borrow from friends and family, they do everything they could so that they could invest as much as possible into that stock that they're claiming is going to pop, but they don't do that. All they're doing is making a sensational piece of content to attract our attention, and now we get to blow them off forever because we know we can't trust them. The strategy that I'm sharing today is actually something that's just as simple as picking an individual stock, and it's also something that I'm putting my own money in. But even if everything I've just said doesn't really apply to you, and you're not taking hot stock tips from Johnny Dollar Bills on TikTok, you shouldn't trust your instinct to pick stocks, because the data on regular people attempting to pick stocks is downright tragic. We suck at this. Take a look at this data with me. We invest more when there's lots of buzz in the news, and the truth is that's too slow to take advantage of the news. We would have needed to make that trade a week before the news came out to be able to ride the wave and take advantage of it. Younger people and people with lower income in particular are more likely to chase these kinds of trades. What these charts are telling us is these people in blue who are under 40 years old are more likely to chase trades based on market volatility. Things are changing. Either it's a big up or a big down. And as a result, us young, stupid people decide this is the time I need to trade. This is my edge. This is when I have an advantage. And then similarly, these green columns are saying the same thing. People with a lower income are more likely to be affected by volatility in the news or in the market or whatever, because somehow we trick ourselves into thinking again, oh, this is the time I need to act. And this isn't some kind of outlandish behavior. This is really popular kind of investing strategy that you might see online, something like dip buying. Oh, look, the stock market has had a big dip. Now's the time to buy. Everything is on sale. This is the kind of stuff that gets us in trouble, guys. The average investor from 1996 to 2015 only got a 2.1% return. That's horrible. That's a joke. As volatile as things are nowadays, and as hectic as some people's trading activity is, I think a lot of people have a net negative at the end of the year. Getting a 2% return is financial suicide. You can get better returns than that right now in a savings account. Don't even use the stock market if you're getting returns that bad. Just keep your cash in a high yield savings account or throw it in a CD or something like that, and don't look back, at least for now. But in the future, those rates are going to go down, which means long term, we all need a better strategy. We all need something that's literally as easy as your original plan was, which was to pick an individual stock and ride it to the moon. But we need something that's going to give us a better return than the average person gets, and a more stable return than that. All right, enough lead up, Brendan. What are we talking about here? What is this investment? I'm going to give you two different ones to pick from. Pick your poison. The first is just called VT. It stands for the Vanguard Total World Stock ETF. And what this does is literally invest in the entire US stock market and the entire world stock market all in one investment. It's so easy. And if you're like me, one of your first questions might be, well, hold on, Brendan, why do I want to invest in the whole world so much? Because the US stock market has performed the best over time. So is this putting me into too many risky, like new countries and developing worlds and things like that? Well, the reality is that the United States is still the strongest economy in the world. It's got the biggest kind of market share in terms of companies that are out there in the stock market developing value for you. Plus, the smallest countries in the world don't have a bunch of like publicly traded stocks and things like that. And so you're naturally shifted towards first world companies. Check out this little chart for a better comparison, because if you look at this, only 10% are emerging markets. That's like the smaller countries who are getting things going, who aren't as well developed. 14% is Europe. obviously very well developed. Almost 10% is the Pacific, less than 0.2% is the Middle East, and 66.1% is North America. Most of that is America. And how well has it done over time? Well, really well. If we look at these numbers in this column that are the total return by market price for the last 15 years or so, it's been pretty ridiculous. Over 15% the vast majority of the time. Every now and then you get a little negative year, but that's what the stock market does, right? Minus 10%, minus 1%, minus 7. The rest of the time, look at this, 32%. Are you kidding me? Last year, 2023, was a 22% return. This is madness. 24% return in 2017. And the beautiful thing about having this distribution across all these different countries, as you can see in this breakdown, is that let's say one particular company has just a horrific year for whatever reason, natural disaster, conflict, whatever it is. Because you're investing in all these other countries, you're naturally insulated from getting dragged down by them. Because what if like your one stock pick, let's say, is a Japanese automaker, like you're just all in on Toyota or something. You think they're going to be the best. They've got another sports car coming out. Whatever's going to happen, they're bringing back the LFA. Then if for some reason that doesn't happen, had you gone all in on them, your portfolio would be sunk. You might have a 30 or 40% loss that year. But because it's only 5.6% of your overall here, you stand to still benefit if they pop and do really well. But all of your eggs aren't in one basket. You've got exposure to semiconductor companies and chocolate or whatever they're making in Switzerland, and cars in Germany, and kangaroo backpacks or whatever's happening in Australia. All of these companies across the entire world are working their hardest to grow your portfolio for you. And here's the incredible thing. You're not paying somebody a bunch of money to put this together for you, to develop you this special portfolio that's going to give you a bunch of returns and not that much risk and everything's going to be great for you. All you have to do is pay this guy an insane amount of money to manage the money for you. No, you're not paying anybody to do this. The only drag on your account, the only thing that's bringing you down every year is this itty bitty expense ratio. Like the genie in Aladdin, itty bitty living space. Your expense ratio is 0.07%. It's not even 0.1%. That's how much you pay every year to Vanguard to have access to this fund. Then you're not spending your life trying to research stocks and what does your boss say at work and what's Uncle Larry say at the Christmas dinner table, what's the next stock that's going to pop and what's some guy on TikTok say. No, you just shovel as much money as you can in here and you sit back and watch it grow and you live your life. Option number 2 for you with an even smaller expense ratio of 0.03% is called VTI, and that's the Vanguard Total Stock Market ETF, which is just the United States. It's all domestic stock in the United States of America. And the returns of VTI have been even better than VT. Look at these. It's ridiculous. 33%, 21%. 30%, 25%, 26%. And check this out, this number year to date so far this year, year to date returns based on market price, 27.6%. This is absolute madness. It's so good. So why would you pick VTI over VT? Well, maybe you want to be a little bit more aggressive in terms of just focusing on the United States and counting on us continuing to grow like we have in the past. Maybe you don't want to have exposure to international stocks for whatever reason. Maybe you're tempted, like a siren song, to the lower expense ratio. 0.04% isn't going to make a big difference in the scheme of things, but it is cheaper. But there's still one more big problem we need to talk about here, because so far, I've kind of painted this picture of you just invest in these things and everything's rosy and we won't have any problems and everything will be great. But the question is, can we trust that the world will keep growing its economies? What about world conflict and wars and disease and all the big bad stuff? Won't that wreck our finances if we trust something like this? Well, the way I see it, we have 2 options. Number 1, invest in the stock market and trust that it will keep growing. Or number 2, buy 40 acres of land in a desolate area, build a doomsday bunker, stock it with rice and dehydrated goods and bullets, and wait until everything implodes. And doing that preparation for the worst seems like the safest route to a lot of people. They're called preppers. If things get really terrible, they're going to be more ready than the rest of us. But since that worst case scenario hasn't happened for many, many decades, or maybe ever in America, depending on how you look at it, and if that continues to not happen, then all those people who spent all that time and money and energy and mental effort and stress prepping for an event that doesn't happen means they've wasted an incredible amount of their life. They've prepared for something that's never come, and they would have been better off just investing their money or spending it on burritos and race cars or just being happy, not worrying about the next international enemy that's right around the corner. We got to watch out. We got to be ready. Maybe I'll eat crow. Maybe I'm totally wrong there. But personally, I think the odds are best that peace is maintained, that the world continues on. It probably doesn't keep growing infinitely. I don't see how the rate of growth can continue like it has in the past. I think it's going to slow down. That's just my opinion. And it's not a terrible idea to be a bit prepared for hardships. But for me, that looks a lot less like a bug out shelter and a lot more like trying to become harder to kill or get further from death personally. Like I can still invest in the stock market and get harder to kill. If I'm healthier physically and mentally, then I'm going to be a lot more useful and live a lot longer in an apocalypse-style world event. If you've got a great bug-out shelter and all the ammunition and all the food, but you're 450 pounds and you've got bad knees, you're going to have a really hard time. It kind of doesn't matter how prepared you are. Plus, I think there's a lot of ancillary benefits to being harder to kill or further from death. So I think for me, those are the two kind of balances I want to strike. Lots of stock market, lots of health. Then I'm kind of ready for both scenarios if that kind of thing happens. I'm curious to know what your take is on that though. Are you more of a doomsday person, a stock market person? You got some gold bars buried under the floorboards? Actually, maybe don't tell that on the internet because someone might find them. But how can we make sure that we've got enough burritos in the apocalypse? Leave me a comment explaining how we can do that. Or instead, watch this video next. See ya.